For the next technique, we're going to use moving averages. And the way that you can establish a moving average on the chart is to go up to the indicator menu here and just click it once. You can see that I have a number of different favorites right now, but if you just want to add something like the moving average, you just start typing it in. You can see that it fills out. Go ahead and click it, and it will add a moving average to your chart. As you can see, the moving average is this blue line right here, and it defaulted to using a 9, which means that the place where the moving average trend line is right now represents the average of the past 9 days worth of price action. And in this case, it is using the close of each day. So where the price was at the end of the day for the past 9 days. You can adjust the inputs for each one of your indicators by just clicking the settings gear icon over here and then going to inputs. And if you wanted to make the 50-day moving average, for example, you just type in 50 here. You'd leave it on close because that's the standard for that particular moving average. And when you hit OK, you can see that the line now redraws to be the past 50 days of price action. There are a number of very common moving averages that people use when it comes to looking at charts, including the 11-day moving average, the 21-day moving average, the 50-day moving average, and the 200-day moving average. One of my favorite analysts is Carter Worth, and he introduced me to the 150-day moving average. The 150-day moving average provides a significant amount of support and resistance when you're talking about an investment class. So what you might want to do is have multiple moving averages. So in addition to the 50-day, you might want to go up and add another moving average just by clicking the indicator again, and you can see now we have a second moving average, which once again started at the 9-day moving average. But in this case, we're going to increase it to 150 days. And since the two colors it picked for us are blue and darker blue, we're going to change the color of the 150-day moving average to red. And you can do that just by selecting the different color in the style chart here. You can also increase the thickness. So we'll increase it to 4 pixels to make it a wider, more visible number. And you can see that in the price action, we just moved above the 150-day moving average. So let's go ahead and add the 200-day moving average as well. We're going to change the 200-day moving average to teal in color, and we're going to increase the thickness as well. And you can see now that the SPY is starting to approach the 200-day resistance line. Whenever an asset is above a moving average line, that moving average line will act as support. When it comes down and touches the line, oftentimes the asset will bounce off of a moving average. And the same works in reverse. Whenever an asset is under a moving average line, instead of support, that moving average line is often resistance, which means the asset will go up, hit the moving average, and then bounce back down. And there are plenty of times in the past where you can see this in action. You can see here the 150-day moving average in red provided support before it broke down. It came down and hit it for a couple of days and then broke below it. Then when SPY tried to bounce, you can see that it had flipped from being support into resistance, and the SPY ended up selling off even more. Using moving averages will give you a little bit of insight into whether or not the asset will find resistance or support based on where the price action's going. So you can make your buying and selling plans based on just simple moving averages.